Welcome, it's Drew Blazsik here with Logos and Markets. We're going to talk about in the sim method, we've got the Excel sheet. We're going to go over a put and a call, and we're going to look at how to plug in the actual function in Excel, and we're going to see how the graph works. Again, you could download the Excel sheet right below, or you can go to Logos and Markets website under Sim Finance, and you can find option trading, and you have the all the Excel files that you want there. Okay, so let's go to the Excel file here. The first thing we're going to do is a put. We're going to look at a put contract. And remember, it's a right to sell at a certain price. So let's plug this in. The first thing what we want to do is we want to look at what is the current stock price in all our examples. We're going to say $100. And that's going to be the current stock price. That's the spot price, what's going on today, currently. Then we want to know what the strike price is. In our example in the introduction video, we said 90. So I'm going to put 90 there. And then we want to know, well, how much, and again, that 90 is the right to sell at 90. Then we want to know how much is this going to cost us. We'll say it's $3 premium. That's the contract price. And then we want to also do is, I said that stock price is 100, and you can put any percentage you want. I'm going to say 5%. I want increments of 5. So I want, here's the current stock price, negative, all the negative 30 or to positive 30. Or you could say 10. You can do any value you want. It'll automatically adjust. And then we got the stock price. It's continuous compounding, what we typically do with option trading, those prices. So I'm going to go back to 5. And all we're going to do here is we're going to do the equation that we learned right here in the previous video. And we're going to plug that in. And what we're going to do is I'm going to start at the spot price for the put, what to plug in. We want to make sure that we do this correct. So we're going to long the put and want to know how much money we're making on the different variations of the price. And we're going to say equals. The first thing I'm going to do is I'm going to subtract out the premium. That's the cost of the contract, right? So right away, that's going to be a -3. And then I'm going to put function F4. You want to make sure you put dollar signs. I'm going to make that an absolute reference. The reason is I don't want to plug in every single cell here. I want to drag that down and copy that formula. But I don't want that premium to copy down. I want to stay at 3. Next, I'm going to say plus. This is going to be plus. And remember, anytime you buy an option, it's the max function. And I'll explain what that is. I'm going to put 0. I always put 0 first. I want the function of my profit loss. I want whatever is greater, 0, or if I make money. And if it's not making money, I want it to be, I don't want it to be negative because I'm going to exercise the contract. I'm not going to make a bad deal for myself. I'm only going to do it if I make money. So I want whatever is greater, 0 or the function. Now you want to think about in a put, if the stock price is, let's say 50, that means I can sell it at 90. 50, so my profit loss is going to be the strike price. Oops, I forgot to hit the comma. It's going to be the strike price, function of 4, I don't want to drag, minus, and what I'm going to do here is I'm going to put that stock price there. I'm not going to make it an absolute reference because I want to drag that up or down. I want it to be all those different prices, but I don't want the premium or the strike price to change. So I'm going to close it up. So again, it's real important to put that 0. So if we did it correct, it's going to be a -$3. That means if the stock stays at 100, I'm not going to exercise it. Why would I sell it at 90 when I had? You could sell it at 100 when the stock price is more. I sell it at 90, but the stock you would lose money there. So it's just going to be that, and that's what the max function does. That would have been a negative number, but it only did 0 minus the premium. So if I drag this down, again, if the stock goes up, that's great if I own the stock, but I will not exercise a right to sell. And then it's going to be the -3. I'll let it expire. Now let's go. What if the stock was to 95? Well, I can't exercise it until 90. Well, if it hits 90, I'm still down -3, right? It's at 90, and I can sell it at 90. Well, what if it goes to 86? If you did the function correct, that means my profit loss should be a positive $1, right? I could sell it at 90. I made 4 on that. It's 86, so it'd be 90 minus 86, but it cost me 3. And if I drag all the way there, there's my profit loss. And then you want to look at, well, what's my break-even point? My break-even, well, you can see it right here, is if I could sell it at 90, if it hits 87, that means 87 is my break-even dollar amount. Just so you know, it's going to light up all green when we do this. I got to go into the engine to see why it's doing that. But now let's do the seller perspective. That's going to be a little different than the buyer. So we're going to say equals. The first thing you want to think about is I'm going to make $3 on the premium. So I'm going to hit that premium and I'm going to make it a positive value. I'm going to hit function of 4 because I don't want it to drag. I want it to be an absolute reference. And then I'm going to say plus. Remember, when you sell an option, it is not a max function. It's a minimum function. And always do this. I did this video earlier and I forgot the 0 and it came out wrong. You have to do 0. And the reason is, now the seller has to honor the contract, but we're going to do a minimum function is because we want to, if the buyer doesn't exercise it, well, I want whatever is less. Is it 0 or my function? And it'll make sense in a second. Okay, so the seller is going to be the opposite of a buyer. The buyer is this strike minus the stock, right? You want the buyer is easy to think about, but the seller is the opposite because they have to they're mirroring the buyer. If the buyer makes 10, the seller loses 10. So they're going to do the opposite of that. So it's going to be the stock price minus the strike price, function F4 for the strike. You want to remember that. Make sure that 0 is there. If you forget it, it will not work correct. And like I said, I don't know why. I got to look into it, why everything lights up 3 when I do that. Now I'm going to drag this down. Now, if the buyer is making 3, the seller losing 3. The seller's making 3. So it will expire, and that's what the seller wanted. They say, no, I don't think the stock is going to drop. Because if it does drop, I'm going to lose a lot of money. But I'm going to make 3. So it mirrors itself. And now what we're going to look at is when I drag this up, I'm hoping if I did it correct, it's going to be the opposite of the buyer, and we did it correct. The buyer makes 13 and we lose 13. And you can see, just like we in the introduction video, when I drew the picture, this did the put and the call perfectly. I want to show you a couple things here on the graph. If you want to play around with it, you could hit the filter. You can unselect it. You could take off the cell. You have to hit apply. And you could just look at the perspective of the buyer of the put contract. So it does give you some options there. Hit the filter. If you have a Mac, it does not pop up. You have to look for the filter in the settings. I don't remember where it is. I don't use the Mac anymore. I gave it up. But just know I don't believe the Mac will appear. Well, there you go. There's a put contract. And just let you know, once you plug that in, you can do increments of 10% if you wanted to, and it will look a little different. Again, it's continuous compounding, how it looks. You could change a bunch of stuff here. I could hit, say, 200. Well, I don't want to mess it up too much, but plug in your own numbers. You can look at any stock, and you can see what your profit loss will look like. Hey, thank you very much. This is a put contract. Again, go to Logos Markets website if you want to have all the Excel files. I offer it.